Good morning, everybody, and thank you for joining the first of a series of webinars we'll be hosting as Baringa Partners to launch our Global Energy Perspectives capability. Our Global Energy Perspectives capability will produce compelling opinions, industry-leading viewpoints, and propositions on topics associated with the energy transition, net zero, the evolution of energy markets and policy, and the changing global energy economy. My name is Alesh Patel. I'm the Global Strategy and Markets Lead for our energy resources industry here at Baringa Partners and lead our Global Energy Perspectives capability. So today's webinar will focus on the role that hydrogen can play in a future low carbon economy. And to set some context, we really know that 2020s are the crucial decade to shape the future of our global energy economy and a low carbon future. We know what the priorities are. We understand the technologies, business models, financing and regulatory frameworks required to achieve the goal of net zero by 2050. We also know that the journey can be profitable for investors and that we can be achieved at lower costs than alternative journeys. In doing so, we must balance energy security, energy cost, and delivering a low carbon future. A challenge made much harder by the rising energy cost, increased focus on domestic energy security, the cost of living and debt challenges we face, and some of the supply challenges we face today. These demands are challenging, but not incompatible. So in the 2020s, we need to close that ambition gap, the gulf between the low carbon future we need and what we've committed to in law and the reality that our current policies and actions are pointing us towards. We need to decarbonise as fast as possible sectors with clean technology solutions that we can now employ at scale, such as in the power sector with renewable energy sources and heat production in our homes, short distance transport using electric vehicles, and potentially using hydrogen as well to displace gas, which we'll discuss today. We also need to address the methane problem in the oil and gas industry. We know the potency of methane as a greenhouse gas versus carbon. If we do that, we can make a really material dent in the 25% of emissions that sit in electricity and heat production, as well as addressing emissions from short duration transport that contribute to another 15% or so. And a second priority in this context, in the context of the webinar today, and these are in parallel rather than sequential, is addressing to the harder to abate sectors in our economy, specifically industry, long distance transport, and agriculture. The key will be to think about and test commercial viability and scalability of technologies which are emerging, for example, hydrogen, and for example, energy use in buildings. Is there cheaper ways for energy use in manufacturing or transportation for mid-range transport, for example? For these three vectors, which between them account for about 35% of our global emissions, we need to go out and test the technologies which exist today, but need to be proven at commercial scale. So that's hydrogen, CCUS, fleet electric vehicles, sustainable aviation fuel for short distance aviation, alongside carbon pricing mechanisms and the market designs that start to play a role for these technologies. The final task is to address these really hard to decarbonize sectors where solutions require technologies that we've not even yet fully developed. Industries affected here include very long distance transport, heavy industrial processes, shipping, agriculture, and forestry and land use. And the only solution is to accelerate research and development, potentially backed by government, universities, and venture capital. So in that context, today's webinar will focus on the role that hydrogen can play in a future low carbon economy. And I'm delighted to welcome our speakers today, Oliver Ricks, a fellow partner in our energy resources here at Baringa. He's a leading expert on energy systems, the energy transition to net zero, and advised various organisations both on hydrogen and energy system decarbonisation, including the Energy Technologies Institute, the Hydrogen Council, and many of the oil and gas majors, as well as investors. And Shane Hefferman. Shane leads our hydrogen commercial advisory here at Baringa and has been advising governments, regulators, and investors in the hydrogen economy, including many studies looking at the role hydrogen can play in decarbonising economies, and as well as working for investors looking at the specific economics of projects as they seek to move from the paper or the blueprint stage into the development life cycle and potentially the financial close in the future. So in terms of our agenda today, well, what we're going to talk about, we're going to talk about the role of hydrogen in our future energy systems. Is blue hydrogen still alive in Europe in the long run? How mature is the investment capability at this stage? What's the impact of proposed market design rules proposed by the EU, for example? How do you de-risk hydrogen projects, or what are the risks across the development life cycle? And how are global supply chain constraints and input cost pressures impacting green hydrogen and potential project development? So I'd like to thank you again for joining. Encourage you to make this an interactive session by posting questions in the chat. And by all means, please raise your hand virtually if you'd like to ask a question outside of the chat. I'll aim to monitor both of those channels and draw you into discussion during the webinar. So with that, Oliver, I'm delighted to be able to hand over you to talk about the role of hydrogen in decarbonising our energy economy and our future energy system. Oliver, over to you.
Thanks very much, Ilesh. Let's get stuck in. Yeah, it's going to be an interesting discussion. This first slide really looks big picture. So we're looking at a global picture, and we're looking long term. So the role of hydrogen out to 2050. And the graph, we bring together a number of different scenarios that have been published and explore this. Worth noting, all of these scenarios are, broadly speaking, 1.5 degree aligned. So scenarios that reach net zero for carbon around about 2050. Just for a sort of scale comparison, we've shown on the left-hand side here the role of natural gas in the system today. So 2020, where natural gas meets about 23% of final energy consumption, just to put things in context. And what you can see straight off is on the right-hand side, the amount of hydrogen in each of these scenarios is very material. So anywhere between a tenth and a fifth of total energy consumption. Of course, there's a big range in there, which is not surprising, given the type of time frame we're talking about. The scenarios we've got here, just to walk you quickly through those, we've got IRENA, the International Renewable Energy Association, their 1.5 degree scenario, IEA, similarly, the Energy Transitions Commission, a scenario exploring hydrogen. Just to note, this is where they don't assume very large scale efficiency reductions, etc., that would bring consumption down. And then we've got the last one, the green scenario from the New Energy Outlook from Bloomberg New Energy Finance. This is one of three scenarios that they produce. Again, we've picked the one in this case that is heaviest on green hydrogen, the green-blue split you can see in the colours there. So very material. In terms of where there's consistency in the role hydrogen plays, there's a number of areas which are always come through. First of all, replacing grey hydrogen, which is today's use of hydrogen in refineries, producing ammonia, petrochemicals, and so forth. As Ilesh was mentioning then, I think there's the really hard to abate sectors. So in industry, processes such as steel production, which are very difficult to abate any other way. With hydrogen, there's opportunity for direct reduction of iron and electric arc furnace processes, which can decarbonize steel, and kind of heavy long distance transport. So, for example, using ammonia for shipping and synthetic fuels from hydrogen in aviation. Again, these are very hard to abate in any other way. The power sector is really interesting. When you have hydrogen available, that gives you, first of all, the opportunity to be able to produce power at peak in a zero carbon way using hydrogen turbines. So that's something that would come through consistently in these types of scenarios. And then the other role of hydrogen in interacting with a power system is through storage, particularly long duration storage, which is very hard to accomplish through batteries. And in particular, where the overall system is heavily influenced towards renewables, then hydrogen produced through electrolyzers, stored, for example, in gas in salt caverns, can then be used to store and produce electricity again through hydrogen turbines. So that feature, that long duration storage, often comes through. It's worth noting, though, that the amount of hydrogen used in the power sector varies heavily. It's consistent that it is used, but from a sliver in, say, the IRENA scenario through to it making up about 40% of the hydrogen use in that BNF scenario. So a big range in the scale associated with that. Then there's a range of areas where hydrogen is much more of an option and hence comes through in some scenarios, but not so much in others. So, for example, in the area of road freight, there's a competitive situation between hydrogen and batteries. Similarly, for some industrial heating processes where biofuels and electrification can play a role. And then residential heating is a really interesting one. There's a range of different options there, very dependent on the type of building stock, the density of the heat needed between district heating, heat pumps, and hydrogen. It's an interesting one because there are some non-cost factors in there as well. If you are trying to change out residential homes for heat pumps, often particularly with poorer quality building stock, that involves a whole change out of the entire heating system, radiators and everything else. A lot of hassle. It typically would need also significant upgrades to the efficiency of the building. Hydrogen if distributed in theory through a existing natural gas distribution system, means much less intervention on the building end. So there's some interesting non-cost factors associated with that. So that gives the picture overall. The one key point to note here is, well, a couple of key points to note. First of all, the scale of this is enormous. So, you know, just to get a sense of this, if you look at that BNEF scenario, which is all green hydrogen, the renewables required to produce that alone is about double the capacity of today's total electricity generation. So huge scale. And of course, just the ramp up in terms of electrolyzer rollout and the manufacturing and supply chains for electrolyzers required is, again, very, very large. The other point to note is that the hydrogen in these scenarios particularly comes through as you push to 1.5 degrees by 2050, because it's being used in these really hard to abate sectors. If you step back to scenarios that are, say, Paris aligned, so below 2 degrees, but not hitting 1.5, and hence hitting net zero out in more like 2070, you see typically a significantly less amount of hydrogen by 2050, because it is in that tail that it's really scaling up. So, for example, for IEA, their sustainable development scenario, a sort of Paris aligned scenario, is about half the level of hydrogen by this time in that scenario. So, really is coming through in particular as we push all the way to net zero. Okay, so that's a look at the long term. If we maybe turn the slide and focus a little bit more for a second on the very short term. Clearly, with the current energy crisis, there's a very valid question, which is what role could hydrogen potentially play in trying to displace natural gas as Europe, in particular, tries to look to find alternatives given the current situation in Ukraine. If we look on the demand side, the easiest place to do that is by displacing current grey hydrogen, which is almost entirely produced from fossil fuels today, and used for things like fertilizer production, refining, and so forth. And there's really not any material technical challenges to doing that. So there's about 8 million tons of grey hydrogen production today that could in principle be displaced with low carbon hydrogen. If we look on the supply side, however, there's a bit more of a challenge. To have any effect in the next few years, projects would already need to be under development. And if we look at the current pipeline, which is shown here in the second bar along, with projects that we can see with a commissioning date before or 2025 or before, then we're talking about 3 million tons, of which about 2 million are green. Obviously, it needs to be green if we are going to displace natural gas, given that would then be the incoming fuel for the blue hydrogen production. So that 2 million tons could displace about 1 to 2% of natural gas in the short term. So, you know, helpful, but not a large number. If we then look further ahead to 2030, so the REPowerEU targets aiming for Europe for about 20 million tons of low carbon or zero carbon hydrogen by then, split roughly 50-50 between imports and domestically produced hydrogen. So in other words, around 10 million tons aiming to be domestically produced. And if we look at the pipeline there, we can see in the middle bar there, with commissioning dates out to 2030, a healthier looking pipeline of around 9 million tons. Still a bit of work to do to ramp that up to hit the REPowerEU targets. Okay, so if we look at the next slide, then we turn to the question of blue versus green. So you'll have seen the sort of splits we've seen through the course of the last few slides. Even before the current energy crisis, clearly the political focus in Europe was, I think, fair to say, very much on the green side, although not ruling out blue by any stretch of the imagination. And with the energy crisis, sky-high gas prices, clearly that swung even more in favour of green from an economic perspective. The work we're showing here are early results from a study Baringa's looking at to understand the optimal mix within Central and West Europe. So we're zooming in a bit now, just looking at Germany, France, and Benelux, where we're doing modeling to understand the optimal mix within a energy system out to 2050, which is targeting about 7 million tons of hydrogen produced domestically in these countries in a net zero scenario. And what we're able to do there is explore what would happen with different gas prices. So on an assumption that gas prices remain high, what's that optimal mix look like? Equally, if gas prices return to levels that we saw prior to the energy crisis, how does that look? And you can see by looking at in each of the blocks here, the two columns on the right of each block show what we get in our higher gas price scenario and our lower gas price scenario. So not surprisingly, there's a big swing as we go from higher to lower between blue and green. It's notable we still have blue even in the higher gas price scenario. So there's room for both, and in fact, an optimal outcome would have both, but with quite a big swing depending on that level of gas price. You can compare that to today's pipeline on the left-hand side, and that suggests that even if gas prices remain high, there's still a definite role for those projects, even in that world. If gas prices swung back again to a lower level, there's definitely room for more blue hydrogen to come through. The other comparison we can make on the left-hand side of the green box is to the state targets for these countries to 2030. There's quite a big range here because we're looking at what assumption sets you could make for things like the utilization of electrolyzers, which is not quite clear. So there's a quite big range there. But if you look at that range, first of all, it seems to make sense given the sort of net zero perspective looking out further. Arguably, if gas prices come back down again, then that might be a little over where you would ideally be for green, but that doesn't take account the fact that we are equally looking to ensure we've got resilience, and particularly for natural gas supplies, and hence could definitely justify a higher level for green. So that's the picture on the green and blue front. And I think with that, I'm going to pass across to
Oliver. If I can just, we've had a question. If we just go back,
sure, yeah.
Just take that question now. Actually, so we had a question on the scalability of turbine technology, and I think it's a good question if you're in the context of if hydrogen is going to help decarbonize the power sector and hydrogen into turbines, into power, i.e., hydrogen to power is going to be an important vector to help us decarbonize. Is turbine technology scalable? Are GE, Siemens, Mitsubishi, Rolls-Royce making the appropriate investments in technology in order to be able to scale turbine tech to the size we'll need? Any insights on that? Or Shane or Oliver?
Yeah, maybe I'd take that one because we did look at this in the context of whether you can do hydrogen to power by 2030 in Singapore earlier this year, and had a few conversations with OEMs on that basis. And I think what we see is that some of the big OEMs are very much targeting utility scale 100% hydrogen combustion by 2030. I think the initial focus, for the first wave of projects that will probably happen a little bit before then, tends to be more on industrial scale, so sub 100 megawatt units before then. And while there are challenges around flame speed and around injection rate of using hydrogen, which is a much lighter fuel than natural gas, there isn't any sort of panic or sense that those can't be overcome.
Right. So the headline there, Shane, I think you're saying is industrial scale application, kind of 10, 20, 30 megawatts. That's quite a large industrial player, of course, right? Seems like it's capable within current technology, but we haven't yet proved the kind of CCGT style scale of 500 megawatts of hydrogen turbines, plus a steam turbine operating, I'm assuming, as well, to generate that really kind of high efficiency hydrogen gas plant, as it were, into power.
Exactly, yeah.
Okay, great. Clearly, there's a lot of investment going in because we can see the announcements by GE and Siemens. They see that, and many others. They see that as a vector investment for them into a low carbon future, turning away as demand for combined cycle and single cycle gas turbines have fallen over recent years. So it'll be an interesting space to watch. And then just quickly on the blue hydrogen, Oliver, you mentioned electrolyzer utilization. I don't know whether you or Shane want to come in on some of the work. I think maybe do another webinar on electrolyzer utilization. That's a topic in its own right, but maybe just some kind of brief thoughts on electrolyzer utilization, some of the kind of grid-based projects, and how you might optimize electrolyzer utilization. That's Shane, Oliver, one of you perhaps.
Yeah, I mean, sorry, go ahead, Shane.
I think we sort of come back to this on the policy stuff coming up, but
Sure.
essentially it depends a lot on how you regulate how those electrolyzers are used, and the impact of that on electrolyzer utilization and the power price you pay. I think we'll come on to later on. Essentially, for the moment, I think you are assuming that the electrolyzer needs to somewhat follow the renewable load. And for solar that can be very restrictive, for wind that's quite restrictive, and one of the key tactics that projects are using to address that is to oversize the renewable project relative to the electrolyzer project.
Excellent.
Yeah,
That's really helpful.
we'll definitely come back.
Let's yeah, Oliver, I think you were handing over to Shane.
Yes, over to Shane to look a little bit about the state of investment.
Thanks, Oliver. So I think if we move to the next slide, what we've tried to do here is just provide a snapshot of where we are now, year to date 2022, in terms of deal flow versus what we saw in 2021 last year. So maybe to set the scene, in 2021, we had seen targets set in Europe that Oliver alluded to earlier. We'd started to see a lot of MOUs, memorandums of understanding, emerge across continents between areas of cheap supply versus areas of predicted high demand. And we'd start to see some early designs or thoughts around business models for subsidizing hydrogen in places like the UK and Germany for supporting those targets. And as a recognition that proven demand, grey hydrogen, and some of those sort of very hard to decarbonize use cases would need to be decarbonized with hydrogen. As a result, you did have a lot of deals in Europe last year, and as well in potential supply locations such as Australia and Latin America. And we were starting to see deals in North America as well, driven by an initial wave of capital grants for hydrogen hubs and for first-of-kind projects. If you fast forward then to today, you now see a greater deal flow across the globe. That's driven by stronger targets. So countries like the UK have doubled their targets in the last 12 months, driven by that energy security question. And you're also starting to see more specificity around business models. And even though there's lots more to be done in that area, more funding to be committed, you start to see detailed designs for how hydrogen projects will be supported through revenue support schemes, in addition to capital grants. And again, places like the UK and Germany are leading the way in that front. North America is catching up though this year. So it's the single biggest funding commitment we've seen this year is the Inflation Reduction Act in the US. And that will induce a lot of investment in North American projects. It's providing up to $3 per kilogram of subsidies for hydrogen projects. So a huge swing. And that should build on a deal flow which was already upturning from last year due to prior commitments from funding hydrogen projects through capital grants. So you'd expect to see that pink segment in the left-hand bar chart become even more prominent in 2023 as it's gained this year. If we move down to the middle chart, we're also seeing more secondary financing. So that's a sign that bigger players are getting involved in equity deals and they're paying for access to project pipelines. And that reflects a more mature market with a broader understanding of the risks involved. This consists of oil and gas players, renewable players, vertically integrated utilities, and even the big infrastructure funds, the likes of GIG, CIP, Brookfield, all active in multiple deals this year and last year. Finally, although support schemes are maturing, they are still quite early and they will evolve. We've got the first competitive round of funding open in the UK for electrolyzers. There'll be a similar round of funding for blue projects next year. We've got hydrogen in power system auctions in Germany in 2023 scheduled. As a result, we're starting to see some financial closures, but we are still seeing more announcement than closures. And that should really shift materially in the next 2 years for projects serving European and North American rounds, given those competitive rounds of funding evolving. And we should see debt deals come through off the back of that. So that's a brief snapshot of sort of the deal space and the activity. If we think then, as we move to the next slide, about maybe some of the risks involved in getting those deals through. So right now, hydrogen is a risky business to be in. I won't labour over the sort of various shades of blue you see in the infographic in front of you, but just to say we kind of tend to frame the opportunity in hydrogen from the point of view of someone making a play who's perhaps used to making a play either in wind and solar, which is an established industry now, or oil and gas, also long established. What you see in hydrogen is you're carrying development risks, in trying to get access to the best sites, either close to demand, where your distribution costs are low, or close to cheap supply, where you can lower your network costs and get access to cheap solar and wind. But you also see a lot of first of a kind risks which are present at the moment. So you're carrying the risk of technologies that are not yet deployed at scale. This holds for electrolyzers as well as carbon capture units, as well as some of the downstream technologies in point of use of hydrogen. For instance, recently we saw a big disparity come out in data provided by Bloomberg between Chinese and Western electrolyzer capex for the first time, and that highlights some of the risk that projects are taking on in who they choose to buy technology from. We're also seeing a big risk in regulation, particularly in what defines low carbon hydrogen and renewable hydrogen, and whether you can use that hydrogen for blending into the gas grid or whether it needs to be used solo. And we'll come on to that risk of regulation a bit more in a couple of slides' time. And then finally, there's also a level of what I'd call project on project risk that's almost a little bit unique to this asset class right now. So if you are an electrolyzer project, or if you are a hydrogen for fleet decarbonization project, you may be waiting on pipelines, on shipping vessels, on hydrogen storage solutions, on fuel cell drivetrains to develop in time for your project to go active. And in particular, that hydrogen network infrastructure is a key component of cost and competition. So your project may be competitive now, but what if pipelines show up somewhere cheaper in 10 years' time, and suddenly your customer can connect to an area of lower hydrogen production via those pipelines or even those shipping routes?
Shane, one way I've seen investors start to think about the risks and the development risk on hydrogen projects, which you highlight, but both as first of a kind, is often to think about hydrogen projects are really three different projects: a renewable project, a hydrogen electrolyzer project, and then potentially a transport, storage, and customer project. And the risks of each, as a project developer in hydrogen, you're carrying the risks of all three of those inside a single entity, and you've got different regulatory regimes, different market fundamentals affecting those. And one of the ideas I know we've been toying with is thinking about, actually, as you approach financial close, is it best to think about the financing of it as three different projects, because there'll be different risk reward appetites across those three different projects? Is the renewable projects essentially a power purchase agreement seller to the electrolyzer then essentially a conversion technology, a tolling agreement, if you will, with the electrolyzer, which then sells it on to either an end customer or a trader? And is it best to think about that so the right capital finds the right home as you start to think about financing, let alone some of the technology risks that you've already highlighted? I don't know whether you're seeing the same evidence out there, or is that just a limited number of large projects that are experiencing that?
No, it's a great question. I think you're seeing a range of models come in. So, we looked at this in the context of a sort of a renewable developer pivoting into hydrogen, and we sort of did that competitive benchmarking exercise. You see some saying, okay, we're good at renewables, we're good at PPAs, we're going to stick to that, and we're going to find hydrogen projects to do deals with. You see others very much go into, we're going to develop the electrolyzer and we're going to find the end use hydrogen customer. We're going to do it all because we see the optimal value and we see our ability to achieve that value as through dealing with it in an integrated way. So yeah, you do see a range of approaches, and I think particularly when it comes to the interaction between power and hydrogen, the renewable asset versus the hydrogen asset, there is a natural hedge in those things. The analog, I think, is some of the Australian vertically integrated utilities, where if power prices go one way, upstream makes money, downstream makes less money, and if they go the other way, it flips. And so integrating those projects is a way of managing that risk.
Great. And we've had if you don't mind, just I know we've got two more key messages to cover, but I think we've got a bit of time. If we just cover this next question. So Julio Del Paz has asked a question around the scaling up of hydrogen related technologies. For example, he's asking, ITM Power is an example that scaling up is they're finding it harder to scale hydrogen, into the hundreds and 200, 300, 400 megawatts category, I suspect, right? Than initially thought. Is that a technology constraint that's constraining that, or is that something else that's constraining? Is that a regulatory framework thing? Is that a market thing? What's constraining the scale up here as you get into larger and larger sizes? Maybe there's a
Great
couple of different.
question. Yeah, and it could be all of those things. I think if you look at the projections for capital cost, the economy of scale you expect to achieve through electrolyzers, there's quite a big economy of scale going from less than 1 megawatt to a few megawatts. It's much less clear that economy of scale from a project's point of view goes up as you move from 1 megawatt electrolyzer system to 100 megawatts. Clearly there'll be a huge economy of scale in the supply chain once we get projects going that way, but whether you want to centralize your project on a gigawatt scale or do many distributed projects on a smaller scale, that isn't yet clear, I think, within the industry. And to be honest, I think it may well depend on use case. So if you're decarbonizing a fleet of trucks or buses, then that distributed model close to demand is probably preferable. If you're decarbonizing a steel plant, then you absolutely need huge projects.
Oliver, anything to add to that? Without
Yeah.
trying to move ITM share price, which is always very sensitive to market announcements.
I think I'd just say that, yeah, obviously, as Shane said, one question is this scale of installations, if you like. I guess it's perhaps no surprise, and we've seen it in many other sectors and industries, that in terms of just scaling up production, that is a different challenge from getting the technology right in the first place. And a whole range, is presented with a whole range of different types of management challenges, process challenges and so forth that are difficult. So I think, I don't think it's maybe not a surprise, without talking about anybody in particular, that's going to be a stage that the industry has to go through, and is a difficult one. Yeah,
that scale up of manufacturing, commercial scalability as well. What size becomes optimal from a project perspective? I know we'll talk about that a little bit later from a electrolyzer sizing perspective, and also kind of range of kind of different market participants with different capital access, which kind of leads on to another question, I think, just whilst we're here on risks, which I think is relevant, is Catherine Emmett, great question as always around project finance and the role. We need to have a role in green hydrogen, I think that's for sure. And what do lenders need to see to overcome first of a kind risk? And there's a good analogy on nuclear, of course, here, on first kind of a risk. What did lenders need to see on new nuclear in the UK and historically in other markets? And there's many facets of the lender piece, Catherine. I think that will need to be there. I think first and foremost, if I have one ask, if you will, that project's when is to be clear on where the risk is warehoused within the project, and there's a combination of, particularly around market risk. Let's assume we can overcome technical risk for a minute. We'll come back to that. But I think in terms of market risk and commodity risk within it, who is warehousing that risk? So I don't think you can allocate it to everybody. I think it's going to have to be one entity that takes that risk. Is it a project co which covers everything from the renewables right the way through to supply, or is it a trading company that sits in between? Is it, takes the offtake? Being clear on who's warehousing the market and commodity risk over the long term, I think is going to be really important for lenders. Shane and Oliver, any bills on that? What would you say lenders are going to be most concerned about beyond technology, or is it all going to be about technology and scalability?
I think there's an obsolescence risk, right? Because for that technology point, there's a question around, if I'm going to lend against this project, it's not a liquid market in the same way that power is. There won't be a guaranteed buyer, and so if the price of hydrogen suddenly halves in the next, over the next 10 years, I need to set my project up in a way that the end user of that hydrogen is comfortable sharing some of that risk or accepting some of that risk, and therefore I won't be suddenly without customer in 10 years' time, without market, while still in the process of repaying whatever debt went into it.
That's a great point. If I can just before Oliver comes in, because I think there's some analogies there, both with the biofuels to power industry. Can I rely on the supply of biofuels? I think a really useful analogy. Will there be enough supply? Will there be enough customer? And will price keep going up? But also with battery storage, if too much battery storage gets a bit, do the prices of the battery storage services, frequency response, reserve, etc., keep coming down to the point, because technology costs are also coming down, so the cost of providing the service is coming down. By being a first mover and indeed first of a kind, am I risking, or in the lender's eye, am I risking technology obsolescence, in your phrase, Shane, which I think is a really good, maybe it's commercial obsolescence, I think is maybe an alternative way of describing it. Within 3 years, you'll be overtaken by someone who's cheaper and better at doing the same thing that you were doing 3 years ago. Oliver, anything to build on there? Any other risks you think lenders will think about as we start thinking about development, and maybe something on the policy and market side? Is there anything on a policy framework that lenders might be worried about?
I mean, I think that, Shane already made a point in his run through earlier, that the sort of lag where in terms of where we are from a regulatory point of view. I think clearly that's going to be relevant and an important factor for policymakers to ensure that is pushed forward quickly to try and get clarity there.
Right. Shane, should we move on to the next couple of points? I think come some of these areas anyway in those.
Sure. So, I mean, we wanted to focus a little bit on input cost pressures and how they're affecting the economics of hydrogen production, and clearly compression, storage, transport, the electrolyzer capital itself, labour, they're all important parts of the cost stack. But we focused here on the primary driver of the cost stack for green hydrogen, which is the price of power. And it's also the sort of primary uncertainty at the moment in the European context due to the energy crisis. So right now we're paying a lot for power because we're paying a lot for gas. Gas still sets the power price to a large degree in Europe. And that results in an opportunity cost for any renewable project thinking about supplying hydrogen. We've tried to highlight that in this kind of fairly simplistic view here, where we show hydrogen production costs, assuming that either you pay the capture price that a renewable project might receive from the market, so the market power wholesale price the renewable projects exposed to, or the levelized cost of electricity for that power. And we show that for sort of our view of levelized cost and capture prices in 2025 versus 2040. So what that's saying is, if I'm a wind supplier and I supplied my electrolyzer at the same price I could get from the market, we use Germany as an example here in the top 2 bars, then the price of hydrogen as a result is crippling. It's up around $5 or $6 per kilogram. And that won't directly translate into the price that an electrolyzer pays for a PPA, because there are different risk factors involved, but it will put some upward pressure on those prices. And so the levelized cost of electricity, by itself becomes a less reliable guide of what a hydrogen project can expect to get. And we see that as a kind of a key difference between some of the very global macro views of hydrogen cost trends versus the reality of where how power markets work. Now, the good news is we should see competition from other supply locations putting downward pressure on those prices. Competition from places where the pipeline of renewable projects is nice and fat, so places like Spain, or places where there isn't so much opportunity cost or upward pressure coming from market power prices. So places like South Africa, those places, even once you factor in the transport costs of getting the hydrogen or the derived fuel into somewhere like Germany, they should be competitive with local production. The other good news is that, taking the long-term view, kind of moving from the right-hand side of these bars to the left-hand side, is you should see costs come down. That will be driven by falling levelized cost of electricity. They should fall a little further, even though they are quite mature. And that will make hydrogen, in Europe, somewhere between the kind of $2 and $3 per kilogram mark that we would hope to see. The more sobering news that none of us should forget is that we shouldn't missell hydrogen as a cheap alternative to fossil fuels. It might end up that way in places like Australia or Chile, where the cost of production is very, very cheap. But in Europe, at least, hydrogen will fundamentally require policy support. It's unlikely to beat diesel and gas by itself on a pure fundamental cost of production basis in the long term. Consumers will need to pay for it through carbon pricing or other levies, which I think we're broadly starting to accept in Europe, and carbon prices should drive some of that change. So that's kind of a snapshot view of some of the cost pressures. I think if we move to the next, and I think the final slide that we've got today, we wanted to talk a little bit about, how some of the regulation, that lagging regulation that Oliver mentioned, how that impacts costs and where it might settle. One of the big decisions around regulation is what counts as renewable hydrogen. This is a question that the EU's been grappling with a lot over the last year, and in particular, there's three criteria that have been mooted for imposing on making renewable hydrogen green. So one of those is additionality. So the concept that hydrogen produced from renewable power needs to be contracted with new renewable power projects. Can't be through, say, old hydro projects or old early year wind projects. The other is temporal correlation. It's the idea that the electrolyzer has to produce in sync with the power asset that it's contracted with. And then finally, you've got geographical correlation, which is the idea that the electrolyzer and the renewable asset need to be in the same sort of market or price zone. Now, we've done some analysis on this, so we think they will drive the cost of hydrogen production up. And more interestingly, we don't think that will have a positive impact on the carbon intensity of the grid system, which is the main aim of these regulations, is that they're born of the idea that you don't want a sudden wave of electrolyzers negatively impacting the decarbonisation of the power grid. So again, we've used Germany as an example here, and we've looked at how an electrolyzer would take power from the grid both with and without the additionality and the temporal correlation criteria. And we've sort of taken our view of the German power system in the 2030s, where it's significantly decarbonised, but it's still got a good chunk of fossil fuels on it, as an example. And in the left column, you can see, by imposing these criteria, you pay more for power. So additionality and temporal correlation, you pay, over 10 euros per megawatt hour more than if you remove those restrictions completely. But the interesting thing then is if you move to the middle column, you also see that you take power at times when the grid is more carbon intensive. That's the slightly counterintuitive point. And the reason that occurs is because essentially low power prices are by themselves a very strong proxy for when the grid is actually not very carbon intensive. What this means is that even though as an electrolyzer, your wind or solar asset might not be providing power on that specific day or in that specific hour, the broader system, the broader power system in that country might actually be quite low in carbon intensity because other plants are blowing. But by imposing these restrictions, you remove the flexibility the electrolyzer has to turn up or turn down in response to the system as a whole, and you restrict it to the individual project. And that's what's driving that lower carbon exposure. What you end up with then is a more expensive cost of hydrogen produced and also a more expensive cost of carbon as a result. Now, the final caveat I would add to that is that PPAs between electrolyzers and power assets are still an important part, will be still an important part of hedging exposure to the price of power. So the right solution for any system will allow that kind of risk management aspect, that ability to do PPAs, while also allowing for some opportunity for the electrolyzer to provide flexibility to the grid, either by turning up when the grid is low on carbon or turning down when it's very high on carbon. So I think that brings us to the end of the content we wanted to present, Alesh.
Yeah, that's great, Shane. So if I can just quickly recap kind of 6 or 7 of the key messages that you and Oliver just delivered. I think you said hydrogen will be kind of between 1/10 and 1/5 of final energy demand in a net zero system. Wow, that's a big conclusion based on many third-party views, but I think that feels credible, although ambitious. Uncertainty remains in its role for space industrial heating. I think that's for sure. I think there's a lot of people who are skeptics on particularly space heating, as well as in the lighter classes of road vehicle as well. I think you said Europe's on track to deliver about 2 million tons of renewable hydrogen by 2025, potentially 5 million tons by 2030. That's useful, but it's not going to solve the current energy and gas, both price and volume crisis that we're facing into as a result of the war in Ukraine. So don't look to hydrogen to be the savior in the next 2 years. And this will need to improve anyway, I think it was Kiyumi says, to meet EU ambitions for displacing fossil fuels in the kind of 2030 horizon. Future blue projects could dwindle, I think were your words, if gas prices do not return to pre-2020 levels. I think so on the blue versus green debate, very, very price sensitive in terms of the price of gas to whether blue or green wins out, although green looks likely over the medium and long term, I think in the data you were presenting and our analysis, to be such a promising technology, assuming electrolyzer costs continue to fall and renewable costs remain low. Deals are ramping up, which is really great to see, and becoming more diverse in geographies and mature in many nature. And I think we've seen clearly a range of scale of projects between the kind of small pilot projects of 10, 20 megawatts, right the way up to several gigawatts being planned, as we know. Viable projects incur many risks. I think the development life cycle for hydrogen looks different to every other technology that I've seen in a low carbon world. And I think understanding and building up a proper development life cycle for a hydrogen project that is bespoke to both the type of technology, but also the type of market that you're facing into is going to be really important. You talked about expensive power prices hurting green economics this decade, but important competition could help to drive prices closer to fossil fuel benchmarks. So potentially some import projects from South Africa, Chile, Australia into high intensive gas markets. And then finally, I think your message was the constraints on how electrolyzers will run, particularly some of the EU and draft EU legislation, could raise the price of hydrogen without necessarily offering much benefit in terms of lower carbon emissions in terms of the analysis that you've done. So 7 quite important messages there, I think, and some really big things for us to think about as an industry. Great. So we've got a few minutes left. Shall we, Oliver, actually, just before we do that, any whilst I process the questions that I can see on the chat, any builds on those last 2 points from Shane, from your perspective?
Maybe I think actually, just to be clear, I think one of the questions was about can electrolyzers be flexible to respond to wind and solar, which I think hopefully was answered by Shane's description of the roles that they could play, whether or not they're restricted or otherwise in terms of regulation. One point on that, so in principle you could have a completely separate renewable asset or set of assets feeding an electrolyzer, and the electrolyzer can run in line with the output from those assets. Or, as Shane was saying, it can provide this flexibility by absorbing power from the grid at times of low prices, which are likely to correlate with low carbon when across the grid there's a greater amount of renewable production. Was quite interesting in our current study that I was talking about earlier, and looking at the role of flexibility that electrolyzers can play, is that actually a lot of flexibility that gets used when you are pushing to net zero is actually seasonal rather than the diurnal type of flexibility, which can equally be provided by batteries or other flexible assets. And actually, interestingly, we saw out of that study, obviously it's a modeling study, it's not the real world, but definite profiles of electrolyzers where they're running a significantly higher load factor in the summer, and then running less in overall in the winter. So that's sort of seasonal flexibility being an important part of the value that they can add within the system, assuming that they're allowed to do so. Yeah, great.
So Oliver, I think, and Shane, a couple of questions to pick up. We're getting questions fired at us left, right, and centre, which is great. One of them was around this kind of thorny problem of industrial, or rather use of hydrogen versus gas in industries, and how quickly that's capable of what's going to drive the switching. Where industry is going to switch and what types of industries. Then Oliver, maybe you want to kick off on that, and then Shane maybe next, just add in.
Yeah, I mean, it's a really interesting question. I mean, one perspective on that, I suppose, is that so clearly there's some easy wins in terms of where hydrogen is already used, as we mentioned earlier, in terms of grey hydrogen. I think it's an interesting area, the sort of where natural gas is used for heating, as we mentioned earlier, there are different alternatives potentially, as well as hydrogen, that could support decarbonisation there, depending on the temperature required and the process and everything else. That potentially biofuels or electricity could also be candidates. So whereas if you look at some of the harder bigger industrial processes, really there aren't any options. So I think it may be that there's there's the progress on those kind of more diffuse processes or more diverse processes perhaps is a little bit later as it becomes clearer what the economics look like across the different low carbon options, and it may be more difficult to frame early stage projects around those relative to, say, steel projects where there's a kind of clearer goal, it's the only option, and there's potential for green premium in particular in those sorts of markets. But that's just a perspective.
Got it. Really helpful. Shane, anything to build on that?
Yeah, I guess in the near term, it's a question of follow the money. So using the UK as an example, there is capital funding out there to switch away from gas to hydrogen and to biofuels. And that almost sort of rightly or wrongly picks a winner in the near term. I think Oliver quite clearly laid out the different technologies competing with hydrogen in those kind of hard to abate high and low grade heat sectors. Probably the other dimension that changes the answer depending on where you are is geographic location. So the availability of and the extractability of biogas and other biofuels that will be quite region dependent. We did a study on Lithuania earlier this year where there's a huge biomass industry and that becomes almost the default option for industrial decarbonisation. But other areas, you think of the US, Ireland is another example. There's a huge biogas potential, and that could be the solution. And then there will be other geographies where you've got huge hydrogen clusters, you don't have those biofuel options, and as a result, industry within those clusters will may well veer towards hydrogen.
Yeah, great. And then pick up a slightly different thread. So to what extent, if any, could improvements in electrolyzer materials improve the competitiveness of hydrogen with hydrocarbons versus vis-a-vis a need for subsidies? So kind of, to what extent is essentially cost reduction going to play an important role in the next kind of 5 or 10 years in hydrogen displacing gas? The classic question of cost reduction of electrolyzers and renewables.
Yeah, and the cost of electrolyzers will come down, but I think that is mostly predicted to occur through the learning rate and the economy of scale factor rather than through the specific materials used. That being said, there are a couple of interesting technologies out there that could change the sort of the picture around, at the moment the default is it's going to be a PEM electrolyzer or an alkaline electrolyzer. That could change in the future. And I think there was another question in the chat there around thermal plasmas being used to produce hydrogen. Energy from waste, or waste to hydrogen is another one that sort of pops up in some of the conversations we're having. We need to keep an eye on those technologies, but at this stage, it is very hard to gauge. The technology readiness level is sufficiently immature that it's hard to gauge whether they will come to fruition and compete with PEM and SMRs and alkaline electrolysis.
Oliver, anything else to build on that?
No, I mean, all of those scenarios we looked at right at the beginning all assume very significant falls in the cost of electrolyzers, and that is very high level, driving a lot of the outcomes in terms of the green blue mix we see there. Even assuming gas prices returning to normal, so that downward curve is very much built into those scenarios. As Shane said, I think it's hard to say whether a lot of that's going to be driven by scale and production volumes. Some of that, I'm sure, will be driven by technological changes and advances as well. Quite what the mix is, I think, is difficult to say at this stage.
Great. Good. Just trying to scan for any other questions. I think there's a question on price points. Price points are always difficult, I think, to forecast for hydrogen, but kind of any aggregate thoughts on a driver of price points for hydrogen, not PowerPoints for hydrogen, price points for hydrogen, as it were, over the next 5 or 6 years. Anything kind of particularly beyond the norm to watch out for? What people not know that they ought to know about pricing for hydrogen in the next few years?
I suppose we've touched on power being the key component in the webinar, and that will remain true. I think maybe some of the costs that are a bit less understood, or that you see a wider range of numbers being thrown about, are I think the idea of converting ammonia back to hydrogen. So you make hydrogen, you turn it into ammonia, you ship it somewhere around the world, and you turn it back into hydrogen. That process, I think, is I've seen a reasonably wide range of costs quoted for that, and that could be a key difference between whether I burn hydrogen in my CCGTs or whether I potentially burn ammonia. And I think the OEMs are kind of hedging their bets in that regard when it comes to turbine manufacture.
Great, Oliver. Any final thoughts on that?
I mean, I think the price dynamics are going to be interesting as yeah, partly relating to what Shane just said, but as the potential for international trade in hydrogen builds up, yeah, what does that do in terms of the pricing of something that's produced domestically versus something that can be imported with different costs and different cost structures in the early days of a market? I think is going to be really interesting to watch.
Great. Well, look, Shane, Oliver, thank you very much, and thank you very much for everyone who attended the webinar and the questions being asked. I'm going to be respectful of time and diaries on what is a cold but sunny Tuesday morning in October. Our next webinar, I'd love to see you there if you can make it. We're launching our global energy perspectives capability. Next one is going to be in the energy transition. Whilst that feels like a topic that's had much airtime, this is going to be a reasonably unique viewpoint on it, looking across both an investor perspective, but also across the 4 major emitting economies across the world, and our scorecard, if you will, about where we're going to go post the Ukraine cost of living, supply chain, and debt crisis that we're facing. And what is the future for the energy transition, as a bit of a prelude to myself and others giving a little bit of a talk around that at the FD Energy Transition Summit next Tuesday. So please do join us on Thursday, same time, 8:30 in the morning UK time, 9:30 CET. And depending on time zones, I'm sure there are people who joined us from the Far East as well. So welcome. Thank you again for joining. An absolute pleasure to see you all on this webinar. Thank you to Oliver and Shane again, and hopefully see you on Thursday.